Hello friends, welcome to Ecoholics YouTube channel. My name is Avinash Agarwal, and in this video I'll be discussing with you economics current affairs for 4th November 2024. I have selected two articles from two different publications, one article from the Mint newspaper, one article from the Indian Express newspaper. So first article is speaking about India's sovereign credit ratings and how that the sovereign credit rating that India is enjoying at present is not reflecting India's fundamental strength, is not reflecting India's inherent strength, and what are the challenges that India faces because of the rating methodology adopted by credit rating agencies such as Moody's and so on. So we will be discussing the approaches as to how we can improve India's ratings in light of these methodologies. And secondly, we will be discussing the factors which are contributing to the stagnation of rural wages in India despite consistent GDP growth, right? And what kind of policy interventions will be helpful to address these challenges. Okay, so both very relevant articles. I would say that both these articles are technical and a little heavy. I will admit it myself, right? It's not going to be a cakewalk, but I'm going to make these articles very, very easy for you to understand, provided you are willing to hear these sessions out, right? So let us start with my discussion. Let me just check if everything is okay from the sound point of view. So we are speaking about credit rating agencies. So first of all, let me try and explain to you what is the meaning of the term credit rating, right? So credit rating basically means that should you or should you not trust India with your credit? Is India credit worthy? Should you give credit? Should you give loan to India? That is the idea of credit rating. Credit का मतलब होता है loan, right? And credit rating meaning that should we be giving loan to a country like India? So there are different levels of credit rating, right? Okay, let's say that this is the topmost level, and let us say that this is the bottommost level, right? So these are, let's say, investment grade countries that you can invest in them. Your money will come back to you, or your money will be safe, or whatever. These are investment grade countries. And then there are countries which are having a junk status, right? So India right now is within the investment grade, but we are towards the bottom of the investment grade. So is this fair for India, which is one of the largest economies across the world? Is this a fair rating for India that we are at the bottom of the investment grade? Meaning that yes, you can put your money into India, but India is at the bottom of the investment grade. So let us discuss this article. Okay, let me explain everything to you in a very simplified manner, and let's see what comes out of this. So this article and the topic that we are discussing is not a new topic. This is something which was picked up in the 2021 economic survey. This issue was most vigorously picked up, I would say, by the 2021 economic survey, right? In that economic survey, it was mentioned, as has been highlighted by me over here, it was mentioned that never in the history of sovereign credit rating has the fifth largest economy in the world been rated as the lowest rung of the investment grade. So lowest rung of the investment grade is BBB minus or BAA3, right? So there are different nomenclatures given to every level, right? So if this is the bottom of the investment grade, so some rating agencies call this BAA minus, as has been reflected over here, BAA3, right? And some rating agencies call this as BBB. Some of these call this as BBB minus, right? So this is so, and this would therefore be, let's say, AAA, right? AAA1 or AAA plus, right? This would be AAA1 or AAA plus, and there are a host of other levels in between, right? So India was BBB minus or BAA3, right, which is the lowest on the investment grade. Okay, so what is the economic survey saying? That never in the history of sovereign credit rating has the fifth largest economy in the world been rated as the lowest rung of investment grade. That was for India, right? That was in 2021, right? So the survey went on to say that the fifth largest economy historically has predominantly been rated as AAA. Okay. If you look at the history of sovereign credit ratings in the last 30, 40, 50 years, you will see that the fifth largest economy has been rated AAA. Survey went on to say that China and India are the only exceptions. When China was the fifth largest economy, it was having A minus or A2 level of rating in 2005. When India is the fifth largest economy, India was having BBB minus or Baa3, right? That is lowest on the investment grade, right? Now, survey went on to say that this is basically a very unfair categorization. What the survey is saying is that India's sovereign rating or the changes in India's sovereign rating, it has absolutely no correlation with India's macroeconomic indicators. What are macroeconomic indicators? Fiscal deficit, inflation, growth rate. These are macroeconomic indicators. So the changes that should be happening in India's sovereign ratings, they should be reflecting the growth of macroeconomic indicators or the strength of macroeconomic indicators. But that is not happening. And let us say that you make whatever changes you want to make in India's sovereign ratings, right? There is no impact on yield on government securities. There is no impact on the exchange rate. There is no impact on Sensex returns. Now let me explain this last line. This last line is very, very important over here. It's a very important line. Why is this line being inserted over here? You need to understand this. Okay. See, what happens is that as a foreign investor, let us say, as a foreign investor, right, what is the one thing that I have that I can look at? I can look at credit rating. That credit rating is available for all the countries. Okay. And I can very easily look at like how if you play on Dream 11, or if you play on the FPL Fantasy Premier League, or if you play any of the fantasy league games, so there is a rating given to every player. There is a rating for the form of the player. There is a rating for the threat of the player. There is a rating for the scoring potential of the player, and so on, right? So depending on that rating, you will decide whether you want to include that player in your team or not. Similarly, as a foreign investor, you can look at a country's sovereign credit rating, right, and decide whether you want to invest in that country or not, whether you want to give a loan to that country or not, whether you want to buy that country's government securities or not, whether you want to put money into that country's equity market or not, right? Now, what the survey is essentially saying that whatever may be the changes in India's sovereign rating, and you remember that India is at the bottom of the investment grade. So India has only been downgraded. India has not been upgraded. India has always been at the bottom of the investment grade. So given the fact that India has always been at the bottom of the investment grade, yet this has not had any impact on the yields of government security, meaning that people have still invested in India. Because had foreigners not been investing in India, had it been difficult for government of India to raise money, then the yield on government securities would have gone up. Government of India would have to pay a higher rate of interest to attract investors. But that has not happened. If you look at India's exchange rates, we are by and large having a stable exchange rate regime. Yes, as other countries are facing a depreciating pressure because of the appreciating dollar, because of strengthening dollar, so has our currency also depreciated. But the depreciation is very much controlled. If you look at Sensex returns, right, so they have been fine. So it's not as if that our stock market is collapsing because people have zero trust in, let us say, India's financial stability and so on. So the importance of this line over here is this is evidence. This is evidence that the ratings that have been attached to India and the real world of finance or the real economy are completely delinked from each other, right? Now this is as far as the survey of 2021 is concerned, right? Another problem with these ratings that was identified is that these ratings are pro-cyclical. What is the meaning of the term pro-cyclical? Right. The meaning of the term pro-cyclical is that these credit rating agencies, they don't do a forecast, rather they do a post-mortem. These are my understandings. Let me repeat it again. That these credit rating agencies, they don't do a forecast, rather they do a post-mortem. Meaning that many a times once a country has defaulted, they will downgrade that country's credit rating after the default. And let us say when a country is already performing very well and people have already started investing money into that country and loaning money to that country, then credit rating agencies will come and upgrade the ratings, right? So when things have already gone bad, after that they will come and downgrade. When things have already gone good, after that they will come and upgrade, right? So what do I mean by the term pro-cyclical? By pro-cyclical, I mean that when a country is going through an upswing, a good phase, right? So they will upgrade the ratings. So the upswing has already started and then they will come and upgrade. And they will downgrade the rating during downturns. So when the downturn has already started for whatever reasons, then they will come and downgrade. So when a country is going through a downturn, let us say we are having high deficit, low growth rate, high inflation, unstable foreign exchange, low export earnings, we are having this problem, then they will come and downgrade and add fuel to fire, and vice versa, right? So these credit rating agencies therefore are only increasing the stress of a particular country and are not really acting as, let us say, harbingers, or are not really acting as forecasters of what is likely to happen, let us say 1 or 2 years down the line, based on what the current indicators are. Another problem with India's rating is that, given the fact that India is at the bottom of the investment grade, right? So sovereign ratings are relevant for the government. They are relevant for our public sector units which are owned by the government. They are relevant for the public sector banks which are owned by the government majority, right? So these international credit ratings, they impact the PSUs as well as the PSBs, right? So what this does is that this international credit rating, which is at the bottom of the investment grade, they drive their foreign currency borrowing costs, right? So what happens is that, given the fact that we are at the bottom of the investment grade and our PSUs or PSB, because the government of India doesn't take on external commercial debt. We don't take any kind of external commercial debt, okay? But our companies can, our companies may, right? So given the fact that we are at the bottom of the investment grade, meaning that our ratings are not reflecting our strength, so our companies often have to pay up a higher cost when they go for an external commercial debt. And if the lender is looking at India's credit rating to evaluate whether they should give or not give money to PSUs and PSBs. See, ideally what happens is that these PSUs, PSBs, or private sector entity, or anybody who takes on external commercial debt, they take it on the strength of their own balance sheet. That if their balance sheets are strong, if their profit is strong, if their cash flow is strong, right, then they will get a low interest rate. But if the investor or if the lender is hell-bent on looking at credit rating, then it can become a difficulty for our PSUs and PSBs, right? So these are the challenges that we face because of having an unfair credit rating attached to us, right? Now, why is it that we are having this low credit rating? Please understand the methodology, right? See, the idea is that these credit rating agencies, they are looking at per capita income of a country, and they are looking at the fiscal deficit of the country by and large. By and large, they are looking at these two numbers, okay? And in India's case, because of the historical experience of colonization, because of high population, our per capita income is low. Our per capita income is experiencing one of the highest and the fastest growth consistently for the last 34 years. That is also a reality which we will discuss now. But our per capita income is starting from a very low base, right? So historically, our per capita income has been low, and that is something which is a problem for these credit rating agencies in terms of giving a higher rating to India. And if you look at India's fiscal deficit, right? So India's government debt, whether it is gross debt or net debt, it is slightly higher than what it should be. That is also a problem for these rating agencies. So let us see, let us put some numbers, and these numbers are important. Okay, the numbers that I will be discussing with you are very important over here, right? So see, if you look at, and I'll be highlighting some numbers for you. If you look at India's fiscal deficit, right? So that is around 7.9% in 23-24, right? Overall fiscal deficit, meaning center plus states combined together, right? That is the basic idea of overall fiscal deficit. Okay, because I'm sure that you remember that central government ka fiscal deficit is not 7.9%. It's much lower than that. It's close to 4.9% or 4.6%, something like that, right? So this fiscal deficit is more than thrice of Indonesia and twice of Philippines. But I feel that this comparison is not really up to the mark, because Indonesia and Philippines are very small geographies as compared to India, right? Very compact countries as compared to India. Challenges are very different. But ठीक है, कोई बात नहीं, right? So India's fiscal deficit is 7.9% of GDP overall, right? Now what do you need to do? How can you bring this down, right? So there are some very clear-cut solutions. Is that India has to improve its tax to GDP ratio. Our tax to GDP ratio is one of the lowest if you compare with peer countries, and our tax to GDP ratio is half of OECD countries. So if the tax to GDP ratio is, let us say, around 34% in OECD countries, then our tax to GDP ratio is 17%, right? So we need to significantly increase our tax to GDP ratio, because if the government can improve its tax revenue, right, then it can lower its borrowing requirements. If the government can improve its tax revenue, then it can lower its borrowing requirements, as simple as that. What else can be done to reduce the fiscal deficit, to reduce the borrowing requirement? So government can mop up the excess liquidity of PSUs. That can be another step, that a lot of PSUs are sitting on a lot of unutilized or underutilized cash, right? So if you don't have any utilization of cash, you can give a surplus to the government of India one way or the other. Another way is that we can sell non-core PSU assets. What are non-core PSU assets? Land, unutilized or underutilized land. That is the biggest non-core PSU asset, right? So you can start monetizing this. That will reduce the borrowing requirement of our country. So sustainably increase the tax to GDP ratio and try to extract the maximum value out of your PSUs, right? These are the broad two steps that have been highlighted over here. Of course, I can highlight 10 more steps, but that's not the agenda of our discussion right now in this article, right? Apart from that, Government of India needs to start adopting better accounting practices. What do I mean by better accounting practices? For example, Singapore, right? So Singapore is reporting its gross debt as well as its net debt, right? Now I'm going to highlight some numbers with respect to India, right? These are very important numbers for you. So if you look at India's gross government debt to GDP ratio, right? So that will come out at around 86%, which is higher than other countries which are at the same level as India. India is right now at BBB level. So India's gross government debt to GDP ratio is higher than peers at the same rating level. Now, if you look at the net debt, what is net debt, right? So see, the idea is that intra-government debt, meaning government of India has given a loan to government of Maharashtra, right? Government's liquid assets, right? What are government's liquid assets, right? So stocks in PSUs, EPFOs, non-government investments, right? Deposits of government of India and government of states with central banks. So these are our liquid assets. So if you deduct the intra-government debt, if you deduct the liquid assets which are standing with us, right? So the net government debt will come out to be 61.5%. The net government debt will come out to 61.5%. See, because government of India has given a loan to government of Maharashtra, right? So this government of Maharashtra's liability is not a external liability. ये आपस की liability है, right? So if we remove this, this is the biggest chunk. If we remove this, our net government debt to GDP ratio will come out at 61.5%, right? So are these numbers very bad for a country which is the third largest economy and growing at around 7%, right? And we has always honored its debt obligations one way or the other. And you have to realize that most of this debt is rupee denominated debt. You have to realize most of this debt is long-term debt. You have to realize most of this debt is internal liability, right? And you have to realize that hardly anything out of this debt is owed to external agencies and its external commercial debt. Hardly anything, right? So the debt profile of our country, not only is it moderate when you look at the net government debt to GDP ratio, not only is the number moderate, but if you look at the debt profile is also very benign. It is very much something which is controllable, right? So somewhere or the other, the author is suggesting, and I am reiterating, that if you look at India's net government debt to GDP ratio of 61.5%, then that's a good number. Now the problem is that government of India is not projecting these numbers officially. Officially, they are not projecting these numbers. So we should officially start projecting these numbers is point one. Point two is that Nirmala Sitharaman, madam, indicated in last year's budget, in this year's budget in February, that going ahead in the next 2-3 years, government of India is going to focus on reducing the debt. Government of India is going to focus on reducing the debt, that we'll stop looking at fiscal deficit as an indicator of our financial health. We will look at debt, and year after year we will focus on reducing debt. So in the next 3-4-5 years, with good housekeeping practices, with reducing debt, we should be in a position to indicate to the credit rating agencies that the debt profile is even stronger for India now, and therefore we deserve a upgrade. We deserve an upgrade in our credit ratings. That is point number one, right? Point number two is that credit rating agencies, what are they saying? So Moody is one of the credit rating agencies. So Moody's, they came out with a note and they said that India's per capita income increased to about an estimated $8,300 on a purchasing power parity adjusted basis in 2022 from around 4,900 in 2012, but it remained the lowest among all investment grade sovereigns. It remained the lowest amongst all investment grade sovereigns. This is India's second problem, right? If you look at all the investment grade countries, right, उसके अंदर lowest per capita income even on purchasing power parity basis is that of India, is what Moody's is saying. So that is their second reason to keep India at the bottom of the investment grade of countries, right? Fitch, which is another credit rating agency, they observed lagging structural metrics in the sense mostly your debt and fiscal deficit numbers, right, including government indicators and GDP per capita also weigh on the ratings, right? So governance indicator means your fiscal deficit and debt. GDP per capita is something that you are understanding that we are not having a good number. We are not having a good number, right? Now let us understand what are India's numbers. In reality, let us understand what are India's numbers. Now I'm going to highlight some very important numbers for you, and then we will kind of quickly discuss these numbers. So World Bank estimated that in 22-23, India's GDP per capita is $2,485. This is plain GDP per capita. That you pick up India's GDP, you express it in dollar terms, you divide it by India's average population, and you will get GDP per capita. I will repeat myself again. That you pick up India's GDP, convert it into dollar terms, divided by India's average population, and you will get GDP per capita, right? So our GDP per capita is 2,485, right? So you know that there are multiple categories. There are high income countries. There is a high middle income country ka grouping. There are low middle income countries, and there are low income countries. So India is right now in this low middle income category, right? So if you look at India's number of 2485, so it is marginally higher than the average of low middle income countries, which is 2414, right? But if you look at India's number on a purchasing power parity basis, and what is purchasing power parity basis? In very simple terms, we are not just converting rupee into dollars, right? We are not just converting rupee into dollars, rather we are converting rupees into dollars such that you know the exchange rate that we are using will make sure that the buying power will be common. So approximately, for example, $1, right? And this is something that I had looked up a couple of days back. I don't remember it exactly, but $1 when converted into rupees on a purchasing power parity basis, so the exchange rate would be around 32 or something like that, 32 or 24 or something like that. So it's not your nominal exchange rate. Nominal exchange rate is $1 is equals to 82 or 83. But when I'm using a purchasing power parity basis calculation, so the calculation is slightly complex and different. But the idea is that $1 ka buying power is different as compared to, let us say, 82 rupees or 83 rupees, right? So the buying power is not same. So although you may get $1 at 82 rupees in India, but the buying power of 82 rupees is different, buying power of $1 is different. So we want to use a exchange rate mechanism such that the buying power of the conversion is also equal, right? So when we do that kind of a conversion where the buying power is equal, so that is called as purchasing power parity basis, right? So just remember this for the time being, that on a purchasing power parity basis, India's current GDP per capita is 10,176, which is 10% higher than low middle income's average of 9,308, right? So whether you look at it as, let us say, a GDP per capita basis, we are higher than the average of LMI. Whether you look at it at purchasing power parity basis, our number is 10% higher than LMI's average, right? Important thing is not the number. Important thing is the growth of the number. Now, if you look at the growth of India's purchasing power parity adjusted current GDP per capita number, so this number has been the fastest growing number since 1990, right? If you look at the compounded annual growth rate of India's number, right? So whether it is Indonesia or it is Philippines or it is low income countries or it is low middle income countries or it is middle income countries or it is upper middle income countries or it is high income countries, we have been growing faster than everybody for 34 years since 1990 to 2023. 34 years we have been growing faster. Yes, the number is lower, the number is small, but the growth of this number has been faster than all the countries, all the categories for 34 years by and large, except for China maybe, right? India's purchasing power parity adjusted current GDP number, it will exceed that of Philippines by 2027, right? Will be ahead of Philippines, right? If you look at the CAGR, the compounded annual growth rate of India's purchasing power parity adjusted current GDP per capita number, right? So it is at least 2% higher than low income nations since 1990. So it's not that we are starting from a small base, hence our growth rate number is looking good. Our growth number has been good for 34 years. That is what you need to understand. That is what you need to highlight, right? So what is the conclusion that the author is trying to draw? The conclusion that we are trying to draw is that these credit rating agencies, whether it is Moody's or Fitch, they have not incorporated in their assessment the outperformance of India's purchasing power parity adjusted GDP per capita. They have not adjusted the outperformance of this number, right? They have not understood or appreciated the kind of reforms, the kind of improvements in governance that we have initiated, and the kind of virtuous cycle that we have placed our country's growth and development on, right? So yes, they are definitely looking at countries' GDP per capita, sure. And in that, India is, yes, as we discussed, one of the lowest amongst the investment grade countries, but they are not looking at the growth at all, right? So essentially, we have been penalized for the historically low per capita GDP that we started off with, and we are continuing to be penalized for that, right? So these credit rating methodologies, they work to the detriment of India and probably also for other countries that were once colonized. Because it is not as if that India is poor because India was poor. India is poor because of the kind of historical experiences that we went through. But there is no recognition of that. This is the important chart that you must try to appreciate, that except for China, if you look at the compounded annual growth rate of per capita purchasing power parity adjusted GDP per capita, so if you look at India's growth rate, whether it is current growth rate or constant growth rate, right? It has been higher than that of upper middle, lower middle, Indonesia's, world, Philippine, high income, low income countries. It has been higher, right? And if you look at India's performance vis-a-vis China, right? So we have started performing better than China, whether it is in current terms or in constant terms, and that is understandable because China is now at a very higher base, so they cannot keep growing faster. This is just the growth rate that we are comparing. So in number terms, in absolute terms, yes, we are below, but in growth terms, we are doing fantastically well, and that needs to be acknowledged. This is a very important question. It's a technical question. It is a difficult question that I want you to try and at least attempt, that critically analyze how India's sovereign ratings reflect its economic indicators and the challenges posed by international rating methodologies, and discuss potential approaches to improve ratings in the light of these methodologies, right? So it's not as if that we want the methodology to be completely changed. You have to understand that yes, theek hai, chalo, we need to bring our fiscal deficit down, or we need to bring the government debt down. We need to improve our, accounting practices, housekeeping, etc. needs to be improved, more transparency, better reporting, etc. All that is absolutely acceptable, right? But if you are going to penalize India for the next 5 years, 10 years, until our per capita income doesn't really increase up to a substantial level, then that rating is just useless piece of paper, because any which ways FIIs are putting money into India. Any which ways they are investing in government securities. Any which ways they are investing in the stock market. Any which ways international lenders realize the strength of Indian companies' balance sheets, right? So it's up to you whether you want your ratings to be having any meanings or not. Because for India, it has no meaning, right? Honestly speaking, right? So it's up to the credit rating agencies whether they want their ratings to have absolutely any meaning or not. If they want it to have a meaning, they need to make it reflect the reality. If they don't want it to have any meaning, they can keep living in a bubble, right? Of course, we don't want to have such strident conclusions in your answers, right? But at no point of time should you sell India short in your answers. That is the very clear message that I'm sending to you. That at no point of time should you be selling India short in your this thing. I hope that this is clear, right? Now my next article is a fairly long article. I've already spoken for half an hour, right? Allow me to, you trust me, you guys trust me. I know that a lot of you all have been following these sessions on a regular basis, right? So if I've incorporated an article for discussion, I intend to discuss it, and at the same time, I intend to do justice to technical articles. So this was a technical article that I have done justice to. I hope you'd appreciate that, and allow me to discuss the second article in tomorrow's session along with other important articles. So this will be a small spillover, right? But the fact that this article has been displayed to you, meaning that I intend to discuss it with you. I hope that you will trust me in that, right? So with this, we'll bring this session to an end. I hope that you have learned something out of this session, learned something great and new out of this session. Do let us know through your feedbacks and comments what you feel. We'll meet tomorrow again. Until then, thank you so much. All the best and Jai Hind to all of you. Bye bye.